Okay, welcome everybody. How's everybody doing? Can you hear me? Can you see my screen? I hope it's not too blurry. If it is, please don't worry because we'll be uploading it in high definition afterwards. So please bear with us. Bear with us. But can I please get a confirmation that you can hear me and at least that you can see my screen, even if it's not great quality? Great. Okay. Getting some confirmations here. Perfect. Okay, so yeah, welcome everybody again. My name is Hubert. You probably know me by now. I'm doing the educational videos for trading strategy guides, and today's topic will be about moving averages. And yeah, I think without further ado, let's get going. Can I maybe get a quick idea if people are completely new to moving averages? Who's completely new to moving averages? Who already knows what they are and who already has used them before in their trading? Just so that I get a sense of the knowledge base here. Okay, right. So there's basically quite a mix of people who are using them, know them, and some people who are new. So I'll give you then a brief introduction to them. Basically, you will find your moving averages up here in your sorry, let me just change you over quickly so that you can see my mouse. Okay, so basically just from a technical point of view, you will find your moving averages here in your MT4 platform in this indicator menu option under trend, under moving averages, and if you click on that, a little window will pop up and it'll ask you to put in certain parameters. Now, before I get into that, let's quickly switch over to my notes here. So in principle, moving averages provide, as the name says, an average price value, and you can specify the time period from which the averages are calculated. So on the chart, of course, that then looks like lines. So I have here basically two moving averages that are based on the same time period and one that's based on a longer period. But essentially, it's plotting these lines on the chart, and they basically are based on where price has been in the past relative to the current moment. So I'm looking at the moment at the euro dollar, and this blue line, for example, here is I've specified the period to be 144. So what that means is that it takes the 144 candles from the last closed candle backwards and plots an average value based on an average of all of these prices where they've closed. So whenever the candle closed, it takes that price value and plots an average. And it does that so going backwards, and hence you get this line that's always lagging behind obviously the current value because it's an average that's based on a past, and therefore the bigger of a time period you specify, so in this case I've specified 144, the more lagging it is. If I would specify the period to say, okay, use the last 500 candles, then this would be even more smoothed out, and it would be basically be more slowly to respond to price. Whereas, for example, these ones here, these two, I'll tell you why I'm using them the way I do later on, but just here general now. Um, these are both short-term moving averages, so they just use the 21 period, as in the last 21 candles, to plot their price. And of course, you can see how it's following the actual candles much more closely than this blue line, simply because it's using a shorter moving average. Okay, I'm just checking the chat here. David says, I'm in the middle, really a bit confused. Okay, what were you confused about? Can you write that in? I'll try and clarify that. Yeah, and NB, yes, will definitely. It won't be there straight away. So when it uploads after the live session is over, and you will be able to access the recording straight away on YouTube, and it will be the same quality more or less as the live. But if you wait a couple of hours or so, we'll have time to replace that, I think, with the proper high quality video, and then you'll be able to see it in the right quality. So yeah, David, I'll just check if at some point you're going to write the question. Other than that, it's really just simply different averages of price value that these different moving averages are mapping. And you can say that basically you can consider that price is at a fair value, so-called fair value, when price is near the moving averages. If price is stretched far away from them, like say for example here at this low point, right? The price had moved even quite far away from the short-term moving averages, and was definitely quite far away from the long-term moving average. You can say that this is probably not a great time to sell this currency pair, for example, because it's not within a kind of fair value zone which is close to the average zone. Gas, I haven't talked about entries or exits yet. I will probably do that later. This is more a general overview for how moving averages work. So just stay with us, and you'll probably get some more info later on that. Okay, so now hopefully that's followed everybody. So like I said, MAs are most useful so moving averages are most useful for gauging the maturity of a trend and whether price is above, below, or at fair value. Now, I want to talk a bit about this. Moving averages are most useful for gauging the maturity of the trend because that is the most important function of the moving averages. It can basically tell you whether a trend may be about to start, whether a trend is kind of in its prime, or whether a trend is becoming sluggish. And especially when you use a longer term weighted moving average and a shorter term weighted moving average. Why? Well, if you I'm gonna zoom out a bit here. If you think about it, obviously trend means the price is making progress in one direction much more than in the other. When it's ranging, obviously we don't have a trend, and price isn't progressing up or down, it's staying within a bandwidth. But when price is trending, what you will get is during a range phase, the moving average will be would be pretty useless because they will be doing what you can see here. So during 2016, for example, the euro dollar was in a range and the price was constantly going back and forth um, between the long-term and short-term moving averages because it was just going sideways. And at that time, moving averages are not really good because they lose they lose their function basically, simply because the price movement itself isn't really respecting them a great deal. It's constantly moving across them back and forth. And what you want to have happen really is you want the moving averages to be like bouncing spots. So where you can gauge potentially that that a pullback has occurred, and that might be then a good zone to enter a buy trade, say for example in this euro dollar case here for maybe, and you take that next swing. You don't want to gauge base any trading decisions while moving averages are intertwined like this, because that will lead to many wrong results. So that's why when when something starts to trend, so you get an eventual break of the moving averages. So price, say in this case, moves above it, and at that point we're not really sure yet if this is going to be just a continuation of this range or not. There are some ways to find that out, but just for the sake of the argument right now we wouldn't really know. Say if prices move at this stage, we're just taking note. Okay, the short-term moving average is moving back up above the long-term blue line, but we haven't got a clarity yet. Now, after this big move has happened here, with the picture starting to change, because now what you're starting to see is that the short-term moving averages are spreading out and creating a gap to the long-term moving average. So the space is widening, and that is when trend starts. This is the nature of when trend starts. Moving averages are together, then the short-term moving averages starts to widen the gap between it and the long-term one. And as trend matures and gets into its prime, this space is growing. You can see how the space grows all the way to here. The gap is becoming bigger and bigger, and you can say this is now when a trend is really at its strongest. And then look what happens next. Price is starting to now come back closer to that move to the long-term moving averages. It's starting to break below the short-term moving average here for the first time. See how the candles drop below this band, whereas all the way since down here it's been trading above this band. Now it's trading below this band, and look what happened here. It's hitting the long-term moving average for the first time and uses now that as a bouncing spot. Why? Because the trend has been already going for quite some time. Now it's doing a bigger correction. It's testing the longer term moving averages. It's deciding it wants to go further. And we get another push up. Now, once a trend like this has tested the long-term moving average, and then it starts to approach it again, like here, this is a warning sign that the trend might now be over, because it usually within this cycle you get one test of the long-term moving average, and usually the second test is enough to break it. So let me just address a few things in the chat. What time frame is best? Well, in principle, you can use moving averages on any time frame, but I would always recommend that you use a multiple time frame analysis, And I tell you what I mean by that later on. So just be patient with it. So, okay. And yes, we'll get the replay of that. And I'll address your question regarding why are they separate when they're both 21 EMAs. Okay, so let's get into the technicals. So like I said, you can use moving averages in different ways, and I'm going to show you how I use them personally in my own trading, and you can obviously take whatever you like of that for yourself and incorporate some of it into your own trading, or just take it completely as it is. That's up to you. So what I'm doing here, what I've got on my chart here is I've got, like you noticed, a 21 moving average. The one, however, is applied to the high of the price. So basically, one of these lines is the 21 moving averages, but taking the price at the high of each candle. And the other one is applied to the low of each candle. So my function my settings here are 21 as the period, exponential as the method, and apply to low. So basically that's why there's a slight offset. And the reason why I do that is because in these short-term moving averages, it's more of a zone that price is trading within. And it's better than just having one line, I find, because sometimes the price will drop slightly below the line, and you might think, oh, now the moving average is broken, or sometimes it might just stay slightly above the line, and you think, oh, it's not pulled back enough. So having a zone like this is better. You can see how these pullbacks happen within that zone, and so that's what I like about it. Whereas on the longer term moving averages, I just bother with one because it's a more heavyweight moving average, so that's working just as fine just as one. So let's quickly mention the different kinds of moving averages that there are. So basically in your settings menu, what you will notice is that it will ask you whether you want it to be exponential, simple, like here, or smooth. And there isn't too much difference between them. The main difference is that the exponential setting gives more weight to the more recent price bars, whereas the simple moving average gives equal weight to all price bar within the period that you've selected. Yeah, that's right. I created a dynamic zone, Braille. That's exactly correct. And the smooth moving average is pretty much the same as the simple moving average, but it also takes into account the price data beyond the specified period, but to a lesser extent. So in a way, that is the most smooth. And it, as to which one is best or so, well, it's probably up to the individual trader in the end what they're using and what's kind of worked for each person. I've personally settled for the exponential moving averages because I do like the fact that they're giving a bit more weight to the more recent candles, which obviously, because we're trying to make decisions in the current moment, I think that works quite well. But the most commonly used ones are the simple moving averages. So the most commonly used ones are the 20 simple moving average, 50 simple moving average, 100 and 200. And it's quite good if you want to stick to a combination of those two, because in some ways the more traders use them, obviously the more people will see the same thing. However, I've found that certainly with the longer term moving average, the exponential moving term average, that works really, really well as the 144 EMA, which you can say is an odd number. It's based on a Fibonacci sequence, so it's a Fibonacci number, and it's I find that it's actually using it's hitting these bigger corrections perfectly. When I can show you this in many charts, that whenever there is a trend established, the long-term moving average is a really good gauge for that final move of a trend. See, we have a big downtrend here, correction comes, it's pushing into this long-term moving average, and we get a final push down before then a trend change happens. And so it's really good for gauging that final move of a trend. And yeah, I certainly like it a lot. I will. I'm showing you the big three later on, because you can obviously use that for any purpose you like. I have actually tried that just with my own system as well, which is really nice. So what I do is I switch one of them. Well, no, I turn the third one into this band, and so that I use it in the way I like it. But obviously, the big three indicator is really quite flexible, so you can do whatever you like with them. But you can use the default settings as well, which is I think 20, 40, and 80. So I'm just reading some more questions here in the chart. 1 second. You can use. I don't quite understand Braille's question. Denise, I'm using. Let me just write this down for you. So my personal method is 144 EMA long term and 21 EMA high, as in apply to high in the settings, and 21 EMA apply to low. Okay, so no problem. Oh yeah, I had already written it down here. So yeah, and now I've told you basically how this happens here. I can show you this in other examples as well, like in the stock market. Stock markets trend quite nicely, more so than forex. So this is quite nice to use moving averages here too. Here, for example, I'm using looking at the Nasdaq index, and I'm looking at quite a big time frame, right? I'm looking at a weekly time frame here, and obviously we've been trending ever since 2009 upwards, and here too you can see how price came back above the long-term moving averages, then it's trended upwards, is expanded, it widened the gap between the long and the short-term moving average. Then look, it tested the long-term moving average in 2016, perfect hit, and it closed just above it, and that's always a good sign that it might spike below it, but if it's closing above it, that's really a good sign that you're gonna get a good bounce. And look, we had another push up. Now I believe we're very close to a bigger correction, so I do believe that this price is now going to come back down to the moving average, the long-term one, and most likely possibly break it. It might start to get really messy here. The moving averages might start to interlock for a while, But I definitely think because we had this touch here, for example, obviously I'm analyzing this chart in other ways as well, but just purely from the moving averages based, once you see a hit of that long-term moving averages and another push up, don't expect it to do that again necessarily. It might be now coming in for a bigger correction. And so in order to, let's go back to that question actually of how to use it on which time frame. And that depends in a way. You've got to find a time frame that's showing you a trend. So like say in this case, for example, you've got to find a time frame where price is giving you this beginning, middle, and end of a trend type of thing that I was talked about. Because in this case, it's on the weekly chart, these moving averages are creating what I was describing quite nicely, as in they're intertwined. We're in a, sorry about that. We're intertwined here. Gosh, where are we now? Oh yeah, right. So price is ranging. We don't know. We could go in a bigger time frame yet, and we might see that this is just a small correction, but we're ranging right then. Then price establishes itself up, bounce, and goes further up. If I now say were to go on a smaller time frame on the daily chart and look at that same piece of price action, the picture looks quite different. You see what was a nice clean bounce of the long-term moving average on the weekly chart, which was basically it bounced here at these lows. It looks very messy on the daily chart. You see, here you would think, oh my god, the moving averages are completely useless. And why is that? Because you're looking at a trend that's on a bigger scale. So if you even go down to the daily chart in this Nasdaq trend, what looked like a temporary correction on the weekly chart is a bigger correction here. So in fact, you will get the same start of a new trend here after a bigger correction as you got on the weekly chart much earlier on in 2009 already. So you can use this time frame, for example, but you then can gauge it in a new way. You can say, okay, this is a big correction, and now you could say a whole new trend establishes itself from this point onwards. I'll show you that again here. Going back to the weekly chart, look how here the bounce is just right, because from a weekly scale, this is just still all one trend. On a daily time frame scale, this is several trends in a row. I'm just gonna address a few more questions here again. Yeah, look, the question here is, if does the strategy work well on the E-mini S&P 500? Yes, they work well on any markets because they are simply making a price average. They're giving you a gentle guidance for whether price is at a fair value or not. And the main importance is this, that you see if there's a trend or a range. If price is looking like it's in a bigger range, then don't use the moving averages, but essentially you can use it across any assets that you want. David, yes, the video will be available for recording and it will be in a much better quality. Then Another question here, how to trade it with harmonic. Yeah, well, that becomes more complex, and we don't have time for this in this session, but we will be talking about harmonics in other videos. So to go back to time frames, so yeah, of course you don't want to, most of you probably don't want to trade on a weekly time frame because it takes a long time, etc. But the scale applies on any time frames essentially. So you've got to just simply find a trend, and I would say the 4-hour chart is probably the lowest one you want to go for finding an establishing trend, and using the moving averages in that similar fashion. So, for example, we can look at the euro dollar again, and just looking at that trend that happened in 2017, the uptrend. So you can see in the euro dollar, we're getting the best look for this general trend on the daily time frame, because we get the classic break above the moving averages, widening, retesting of the long-term one, and the final swing. But for trading, then you can go down into the 4-hour chart, for example, and we can now look at what happened here. So see, this was the beginning of the uptrend on the daily chart, and you can see how price actually bounced repeatedly here in that long-term moving average area, because it's a bigger scale of a trend. So essentially you're getting more opportunities. And if you can see a trend emerging on a bigger scale, that's really good, because then you know that there's probably room to trade more of that on smaller time frames. But even here you can see that before the bigger correction happens, that was in around September 2017, we get that final test again of a long-term moving average. You get another push high, and then it's going into this ranging phase. It's breaking down below the moving average, ranging, and then essentially from a 4-hour chart perspective, a new trend starts from around this point here, starting to the moving averages are aligning themselves again. So, and then I just wanted to give you, a different example of how this works. So what I just looked at in the 4-hour chart is this area here. This area here, that was a range on the 4-hour chart, but on the daily chart, it's just a pullback to the long-term moving averages, and off we go again. So in that regard, in terms of stops and entries, I would definitely, as long as price is trending, you can use the moving averages as your stop losses. So if you get a bounce here, there's no need to put your stop loss any further back than below the bouncing spot and below the moving averages itself. And the target in this case would be at least at the previous high. So at the previous high would be here at the previous top. But this can of course go further. But the most conservative target is at the previous high. And yeah, overall, of course, if you entered anywhere at around here, this would have been a really good reward to risk ratio trade. And I want to add one more element to this general moving average trading, because using them by themselves is still somewhat risky, because you want to have some other factor that verifies that what you're doing makes sense. And so I as a simple element to add, would always add horizontal support and resistance levels from the past. So, and trend lines. In this case here, we can, for example, see, okay, is there a trend line that might help us, that could guide us in some way? And if I then try to draw something here, connect these bottoms. So trend line in this case wasn't that useful because obviously the trend line is far away still from the price. But if that's not the case, then don't worry, then look at horizontal levels, and I would always look at both. And here something interesting is indeed happening because we look at this previous range. We had, let me go to the weekly chart because then that makes it easier. So we're coming here into a zone where there was a bounce in the past. So there was a top here. I'm talking now about this pin bar candle. And then we had quite a lot more touches down here. And even though I'm looking here at lots of resistance, right, because this is not a support in the sense of the price came from above, bounced off it upwards, it was below and it bounced off it downwards. But that doesn't matter because in terms of support and resistance levels, the key thing that matters is whether you get many hits and reactions to that price level. It doesn't matter if it's from above or below. And even if price breaks through it, it doesn't matter either. You want just historically as many touches on that level as possible. If I zoom out a bit more, I would imagine that I will see connections to these levels as well, further in the past. Yeah, here you see, for example, back to 2006, perfect hit of that same level. So what that does for our trade idea then is that we can say, going back to the daily time frame, so what that does is we now have a zone here with these two black lines that we say this is a horizontal support and resistance zone that will give us a good buffer. So you could say if you want to be safer, you can say I'm going to put my stop loss just a little bit below that second horizontal support and resistance to give this more space to work itself out. You might need to adjust obviously your trade size and reduce it so that you have an even risk, and then let that go up. So this is an element that I would always include when using moving averages. I would map out support and resistance levels and trend lines, and then use them as either my gauge for stop losses or as a gauge to double confirm the bouncing spot in conjunction with the moving average. Ahmed, I don't quite understand your question. What the most moving average depend on power of it? Can you try and explain that a bit more what you mean? Then, okay, SIBA, these three moving averages that I'm using, I showed that earlier on, is the band is I'm using 2 times the 21 exponential moving average, and I'm applying one is applied to the high and one is applied to the low, and the 144, the bigger one, the blue one, is the 144 exponential moving averages, and it's applied to the close. Okay, Anthony, your question regarding backtesting. So this is my way of of basically gauging trend, and it's not so much a absolutely fixed strategy. So I didn't back test it in that sense, because what I do is I'm approaching my trading as really a set of tools, a set of systems. So I don't just go, I'm going to enter a trade exactly whenever that happens, and that's it. What I do is the moving averages is one aspect of my trading. For horizontal and resistance lines is another aspect of my trading. Gauging the momentum in candles and counting Elliott waves is another aspect of my trading. So for me, I think ultimately you want to create a trading system, not just a strategy that's blindly doing something every time the same way, but you want to ideally build up tools that you find interesting, that you like, and you combine them then to give you certain, because all we can only ever work with probabilities. We can never know 100% for sure what's going to happen, obviously, and therefore the more tools in a way you have for confirming something, the better. And in the end, you're just trying to find spots that have a high probability of going your way. Um, and so yeah, that's how I approach my trading. I don't follow an, an absolutely strict on strategy, so I always only do this, this, and this. I have a discretionary approach based on the skills that I've developed over time. Then Denise, do you only use the long-term move as your entry or the short-term bounces too? Okay, that's a good question. I use the short-term bounces too. So what I tend to do is, like I said, I use the moving averages initially to gauge the maturity of a trend, and then when I feel comfortable, so say for example in this case, price might have done this, might have created this bounce here, and price is now somewhere in here, somewhere in this zone. I'll create a little square so that we can talk about this a bit. So in my understanding and view of the market, I'm pretty sure that after this bounce we will get another high. It's not so likely the price will just stop here. So that then allows me to look for bounces on a smaller time frame of the short-term moving average. So I'm going now into the 4-hour chart, for example, and see what happens here. So here's the box that I highlighted. And so in this case, for example, I definitely would have used this candle, for example. We've got this really powerful 4-hour candle right here that's in a way bouncing off both in this case, okay? So in a way it's double confirmation. But even if that candle would have happened without the long-term moving average of the forward chart being here, I would have said this is a really good sign that there's going to be upwards continuation of that move. And I'm always keep it in mind from the perspective of what does the overall bigger trend, where is that at? And because I feel confident there is room based on the general structure of how trends work, I would have been quite happy to do that here. And in a way the same here, right? There's one important tip I can give you by working with moving averages like that, and that's in terms of trading purposes. Definitely the 4-hour chart is almost like your master reference for whether there's a trend change is going to happen soon. Because what you will get is, if you get a break, so price is trending, and it's coming back towards the 21 EMA band of the 4-hour chart, and price should continue to go up as long as it stays above that band. And at some point you will get a first break of that band here. So what have we got here? This to me, so we obviously we get a high price coming down into the band, but this is not a break yet, because even though we've got a strong red candle here, let me just zoom in a bit more so you can see that better. Okay, here we are. This is not a break because it stopped at the lower end of that band, and the next 4-hour candle closed bullish again with a pin bar. So a break for me is really only once you get a strong bearish candle on the 4-hour chart here, like this. This is your first break below the EMA band. And that's usually the first warning sign that once you get that, and then a retest, and then another bounce down, like here. So it tried to go up, and it couldn't go above the 21 EMA band anymore. That's then the first warning sign that you're going to get a bigger correction or reversal happening. And that's really good. The 21 EMA band of the 4-hour chart is perfect for that purpose. And I'm just saying, I'm using the 4-hour chart because, you know, in terms of trading purposes and time frames, that's obviously giving you something where you can trade a bit more often. And there is enough, 4-hour candles have enough trading time and therefore enough trading volume in it to give you a confirmation. When that happens on a 1-hour chart, for example, you can often get breaks below the 21 EMA band and then up again if the trend is bigger. But the 4-hour chart is good in that regard. And see, of course, then what happened is we started to go into this long range. It got quite volatile here, of course, for a while, but the trend did not continue. So we went into this range, and then, of course, now we've come to a potential trend change or a bigger correction. That's remains to be seen. Okay, I'm just checking the chat again here. Good. Glad you're happy with that, Denise. Ishaya. Yes, we're gonna look. Welcome. Don't worry if you can't follow what I'm talking about now. This will be recorded and we'll have that all on record then. Okay, then Anthony, talk about my MACD. Okay. Yeah, so I left that on there because that's part of what I use too. And the reason for that is that actually this is the awesome oscillator. So this is a momentum indicator that also comes with MT4 under Bill Williams awesome oscillator. And interestingly enough, this indicator is also actually based on moving averages, and it maps the relationship of certain moving averages to each other and gives you sort of a strength reading then. And this is great, again, to use that in conjunction to gauge trend, to gauge if there is soon a correction going to happen or not. So if we go back to this example here of the euro dollar trend, what you can see here, the trend starts out, we get strength is building in a trend, and you get a higher reading here. Then you get the strongest point here, which matches price, right? Price at this point is at a peak relative to everything that's come before. The awesome oscillator is showing that too. And then, of course, what you get is you're starting to get divergence at some point, and that's the beginning that confirms that the trend is kind of weakening. So here we're looking at the daily chart, which is quite obviously, there's a lot of volume in those candles. you can see the price obviously continues to rise to this point, but the awesome oscillator is showing the divergence. Here the reading is lower than here, the classic divergence. And sure enough, this was our early warning sign that a bigger correction was due. And you can see that how that will work the same way on a bigger time frame. In this case, obviously, I'm going back to the weekly chart, and you can see the same here. There was a price peak here and a price peak here, but on the awesome oscillator we got a lower peak, and so we got a correction. So this is how I use the MACD to basically to gauging this divergence to confirm kind of where trend is at. And yeah, I hope that answered that question. Then another one from Denise: do you ever use shorter time frames for trading? Yes, I do. I personally have come to find that my trades do tend to, I want them to be in the longer term side of things, because the more you trade, in a way, every time you make a new trade, you enter a new risk situation. And ideally, if you can find trades that go obviously in one direction for a longer period of time, it might take longer to mature and develop, but I found that this is better and more profitable and a safer way of trading than going in and out of trades a lot more often. Having said that, that doesn't mean that you can't find entries on smaller time frames for those bigger trends. So that's what I'm personally doing, for example. So I can give you an example. On the Nasdaq, this is partially based on other parts of my analysis too. But say, for example, I was interested to gauge when is this uptrend going to come to an end, and so you can use, in a way, the moving averages not just for trading with the trend direction, but also for gauging potential reversals. Like I said before, here the first warning sign is that we price tested these moving averages, the long-term moving averages here, and now push back up. So I was already pretty sure that this is probably going to be one of the final moves before a bigger correction happens. So I'm based on that, and based probably on some divergence on smaller time frames. So here we're starting to get that. It's not super confirmed yet, but we are seeing divergence here between these tops and the indicator. And then I'm starting to zoom into smaller time frames. So next I'm going into the 4-hour chart, and I'm trying to see, okay, here price started to trend again, created its bounce of the long-term moving average, gone further up, and it's creating divergence on the 4-hour chart now as well. See how this is diverging again here to this. So I was already expecting something to happen here pretty soon, and so there would have been in my system, then I'm looking for these breaks of the 4-hour chart moving average, and say, for example, there is a break. Now in this case you had, there was a kind of a break here for the first time. This wasn't really really a break yet, so we broke it down first here, but then price managed to push through that again. So really, the first breaks were around here. When that happens, then you can go, for example, I would then go in a smaller time frame and wait for pullbacks. So I've got my break, got my pullback, got another break below, and in a way, in this case, it was quite fortunate that it closed quite close again to that moving average. Let me just show you this here. I'll make a little box. So now go into a smaller time frame. So I know this has broken below the 4-hour chart moving average, and now I can say here I've got another strong bounce. Then I can use the smaller time frame to just gauge possibly the end of this pullback so that I get a better entry. I can then go down even to the 15-minute chart, and just because I've looked at it on a bigger scale and I've analyzed all on a bigger scale, all I'm using on the smaller time frames here now is to see, okay, once this move is coming back in here and is starting to show some momentum down again, like around here, I would enter a trade. So I don't bother with the smaller time frames to rely on really telling me that price is going to go in one direction or not, but I will rely on it to tell me the end of a pullback and to then enter it. Okay, now some more questions have come up. Brian, yes, this can be seen later. This will be recorded and it'll be in better quality. And now DK, don't understand why it is that I wait for break and beforehand I didn't. If you meaning the time frames, the reason what I'm doing, okay, yes, I understand what you mean. What's happening here is I'm using actually a reversal attempt here. I'm not going with the previous trend direction, I'm going with the existing trend direction. No, I'm not going with the previous trend. I'm going against the previous trend direction, and hence I'm waiting for a break. Whereas beforehand, if you just wanted to trade in the same direction, then you are obviously, you have the momentum of the previous trend, so to speak, backing you, and therefore you can just take trades at that bounce. But when you're wanting to go against the trend, you've got to wait for enough signals to tell you that there is really, the move has come to an end. And in terms of smaller time frames, no, I think I probably wouldn't go below 15 minutes because it gets a bit more erratic. And I mean, ultimately, you can say you could, but again, I would only really use it for gauging pullbacks. So you could say, if you're really certain about having, after you've done your analysis on a bigger scale, then, and you want to be super precise with your pullback entries, then yeah, you can go on a 5-minute time frame or so and say, okay, when is something changing here in the momentum? It's getting a bit complex, unfortunately, and this is too much for the session. But some of my other webinars do talk about that. So and I will be talking about that in the future again. But yeah, this is how the only way I would use these really small time frames. But I hope I managed to give you a sense of how trends happen within trends, right? There's like they're nested within each other. So that is definitely a way that you can use moving averages and trends on any time frame as long as it fulfills those key steps, right? A ranging phase essentially on one time frame is just a correction on a bigger time frame, and the start of a new trend on one time frame is just the a bounce and the next step of already an established trend on a bigger time frame. So you can see how the price movements are nested within each other. Yeah, exactly. An ABC retrace. So if you're using Elliott waves, that's definitely good. And I personally think Elliott waves can be really useful, especially if you want to become precise with your entries and so on. Elliott waves can be very useful on the smaller time frame. Even you can gauge these little pullbacks better. So if we talk about this, the idea of this entry here, just need to find it now. Where are we? Right, so it's saying, okay, do you want to gauge this pullback on a really, really small time frame? Here we are. So you could see, for example, if you can recognize an ABC correction in here, probably even in a 1 minute chart then. But I'm not really recommending this for when you start out, because you can get so much the wrong end of the stick, and so I rather recommend you away from it in a way, because it does take a lot of experience to do that well. But essentially here you could say, I'm gauging this pullback and I'm waiting for divergences to happen, etc. I'm waiting for maybe a break, of the of the moving averages of the 1 minute chart, something like here, to say, okay, this move is now really most likely over. Obviously, these moving averages on the 1 minute chart are pretty useless because you'll get so many breaks and trend changes constantly. But that's, for example, how you could just gauge really for your entry, not for anything else. Okay, so Mujib, are those EMAs or SMA? It's exponential moving averages that I'm using, EMAs. Okay, let me go quickly back to this. Have I covered? Yeah, I think I've pretty much covered most things. Now, I just wanted to show you quickly how this can work with the big three indicator. Because it's the big three. What's good about this indicator from Trading Strategy Guides is that it visualizes things in a nice way. So I can change this now, say, to my strategy. So I've got a 21 period exponential, apply to the high price, and the next one is also 21 exponential low price, and then here I'll do the 144 exponential, and then make these a bit bigger. Okay, now I'll just delete the other ones that I just was showing you so that it doesn't get messy. And okay, let's have a quick look at this then. For our chart, Yeah, so what's quite nice about this is here, the way I've set this is that let me just check what that line is doing, because the 21 EMA, true, true, true. I'd have to just quickly work that out, how to do it exactly for my particular strategy. But what the indicator is good for is giving you these visuals, and you can change the way it looks to your liking. When these changes of the EMAs happen, of the moving averages, and so you can see here what happens is, for the first time, the the short term and the long term moving averages become bearishly aligned, whereas before that they were still bullish. But here they start to become bearish, and of course the bars are then starting to turn red. And of course, once that happens, then there's a really good sign that there's probably going to be a bigger downfall to going to happen. And I even didn't quite mention that, like, if I just quickly show you this here. So of course, once after a big trend, you get this bearish alignment of the short term to the long term moving average. Like here, now the band is below the long term moving average. Then a pullback towards it is often quite a good entry spot for catching a new trend. And so this is what the big three here is showing you quite nicely. And then in addition, it's giving you can set your stop loss and target areas based on pips. I mean, you can just do that yourself by hand, but I think sometimes the visualization can be really, really helpful. And it's also giving you here this overview, this dashboard of the multiple time frames, and that I think has quite good use, because it tells you whether on the bigger time frames there is still a trend established, an uptrend, and then you can see how on the smaller time frames you get a pullback, and you can then start to gauge, okay, you need to still of course analyze it yourself and look at it, but it gives you a quick overview of what scale of trend is occurring, and on what sort of scale a pullback is happening, and to potentially catch a good entry. So yeah, I hope this is... Yeah, that's right. Sorry, DK, I'm going back to some more questions here. DK saying it's only good for trend markets, not for side ranges. Yes, that's correct. So moving averages lose their use during ranges. And of course, like I just said before, you've got to decide, obviously, for what's a range and what's just a correction. Like, it depends on what time scale you're looking at, right? So here in this euro-dollar example, this during August and September, this was just a pullback in an uptrend. So here the moving averages were still very useful. Of course, on a smaller time frame, it was a range, and they would have been intertwined, and the moving averages would not have been useful. I just come back here, like, yeah. So during this period here, not that useful at that time. So you've got to decide on what time frame it is always, and therefore decide which moving averages of which time frame to use. That's very important. Richard Stewart, once I work out the problem on my system, am I going to put it out? How do you mean that? I don't quite understand the question. Oh, you mean, okay. Goodbye, Richard. um, so no need there. Okay, I think so. That's all. Yeah. So if you're interested in getting the big three as a way to help you chart your moving averages, then there's a link in the YouTube video description, and I think there is a coupon code where you get 20% off that you can use for webinar attendees, and that's the big three 3YT. And if you use that in your purchase, I believe you will get 20% off the moving average indicator. Okay, so unless there's any more questions, I think I will wrap it up for today. So I'll just be here a bit longer while I wrap down, but unless anybody's writing further questions, I'll be closing the webinar in the next couple of minutes. Thanks for listening and wish you all safe trading.